It was March 2020, the week after the markets went into freefall. I was watching a friend, someone I'll call Dave, stare at his screen like it was a heart monitor. His algorithm had just triggered a long entry on a major index. By every rule he programmed, the trade was a go. But Dave froze. He said, "I can't buy here. The world's falling apart." I reminded him, the rules don't care about the news, they only care about the setup. But Dave was already clicking the mouse not to enter, but to disable the algo. The next morning, the market roared upward. It was the first surge in what became a multi-month recovery. Dave missed the entire move. Here's the thing, he wasn't a beginner. He'd built a solid strategy. He'd backtested it over 20 years of data. But in the heat of the moment, his human brain overpowered his mechanical rules. That's the moment I realized, in algorithmic trading, the biggest enemy isn't bad code, it's bad psychology. You can have the smartest strategy in the world, but if you override it when fear or greed spikes, you've turned it back into a discretionary trade. And discretionary trades, for most retail traders, are where discipline goes to die. In this session, I'm going to show you how to stop that from happening. You'll learn how to think like a rule follower, even when your instincts are screaming the opposite. We'll break down the key mental habits that separate the algo traders who thrive from the ones who sabotage themselves. By the end, you'll know exactly how to spot the 3 most dangerous psychological traps in algo trading, and how to build safeguards so you never have to watch profits vanish while you sit frozen at the keyboard. My name is Ben, and welcome to Zenstock, where trading meets clarity. Here we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence. Because in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath. Clear your mind. For the next few minutes, give your trading psychology your full attention. What I'm sharing with you today draws from my own years in the markets, but also from lessons in a book that helped shape my approach. It's called Introduction to Algo Trading: How Retail Traders Can Successfully Compete with Professional Traders by Kevin J. Davey. Davey's core message is simple but powerful. Algorithmic trading is about following rules without exception. Not 99% of the time. Every time. And in a world where most traders believe they can feel the market, that mindset is almost radical. It's also exactly what saved my career. When I first stepped into trading full-time, I thought I had the discipline. I had been through the charts, the indicators, the setups, and I told myself I'm going to follow my plan no matter what. That lasted about 3 trades. One day, I was trading crude oil futures. My system gave a short signal right as crude was bouncing off a key support level. Every fiber in my body screamed, "Don't take it, it's about to rip higher." But the rules said short. I hovered over the mouse, feeling my chest tighten. I took the trade. And within minutes, it went against me. That little voice in my head, the one that pretends it can see the future, started mocking me. So I did what too many traders do. I closed the position early to cut the loss and avoid the pain. Of course, crude turned right back down an hour later and hit my original profit target perfectly. That day, my loss wasn't just monetary. It was a loss of trust in my system and in myself. And that's the invisible damage discretionary overrides cause. They erode the belief that your rules can protect you, making it easier to break them next time and the time after that. Years later, I met a trader who was doing exactly what I had done. She had a great algorithm for trading the Nasdaq index, one she'd tested across 2 decades of data. But every time the market opened with a gap, she'd step in and adjust the trade. Her reason? Gaps are unpredictable. The data said otherwise. In fact, her backtest showed that her strategy's biggest gains came from days with large gaps. But her human brain refused to believe it. By skipping those trades, she was eliminating her system's edge without even realizing it. That's when it hit me. This wasn't about her lack of skill. It was about psychology. The difference between winning and losing wasn't the code. It was the discipline to run the code as written every time. When I finally embraced that, everything changed. I stopped grading my success by whether the last trade won or lost, and started grading it by one metric: did I follow the rules? And here's the thing, when you commit to that, the emotional roller coaster flattens out. Wins feel steady, losses feel contained. You start to think like the algorithm itself, calm, consistent, unemotional. Today, we're going to dig into something that most traders underestimate: the mental game of following your algorithm, no matter what your instincts tell you. It's the part of algorithmic trading that rarely gets talked about in coding tutorials or backtesting videos. Because the truth is, the code is the easy part. The hard part is pressing go and letting it run, even when the headlines are screaming, your gut is twisting, and every ounce of you wants to step in. This isn't about building the perfect system. It's about building the mindset that allows you to trust it. And yes, this is for education and entertainment only. I'm not here to tell you what to trade or how to invest your money. I'm here to help you see the psychological traps before they hit, so you can trade with more confidence, clarity, and control. For me, building an algorithmic strategy is like designing a parachute. All the work, the stitching, the testing, the stress pulls happens before you ever step out of the plane. Once you're in the air, there's no redesigning it. You either trust the fabric you built or you freefall. And in trading, just like in skydiving, hesitation is what kills you. Your job is to prepare on the ground so you can let go in the air. One of Kevin J. Davies' simplest but most important points is this: algorithmic trading is nothing but rules. No discretion. No gut feel. No, this one looks different. If the setup matches the rules, the trade happens every time. That sounds easy in theory, but in practice, most retail traders fight it. Why? Because human judgment feels more flexible. We like to believe we can see things a computer can't. We convince ourselves that skipping a trade just this once is smart. In reality, we're undermining our own edge. I've seen it countless times when working with other traders. Someone builds a strategy they're excited about. They test it over 10, 15, even 20 years of historical data. The backtest looks solid, good win rate, manageable drawdowns, consistent equity curve. They start live trading, and then the first weird-looking setup appears. Maybe the market is down sharply pre-market. Maybe there's an economic announcement in an hour. Maybe a stock CEO just gave an interview that feels bearish. Suddenly, the trader decides, I'll just skip this one. The result? Sometimes they're right, the trade loses. But other times, the skip trade would have been a huge win. And because they skipped it, they've changed the system's performance in a way they can't measure. This is where psychology becomes dangerous. Our brains are wired to overweight recent events, a bias called recency bias. If the last trade lost, our fear of another loss grows. If the last trade won big, our greed tempts us to increase position size. Both impulses pull us away from the system we designed. In a 2017 study on trading discipline, researchers found that traders who deviated from their tested rules even 5% of the time saw performance drops of over 20% compared to those who stuck to them 100%. That's how damaging a little intuition can be. I remember one trader who ran a trend-following strategy on gold. It was simple: buy when a certain moving average crossover occurred, sell when the opposite happened. In backtests, it was profitable and steady. But he hated taking trades right after a large down day. He said, "It just feels like catching a falling knife." We ran the numbers, and those were actually some of the system's best trades. By skipping them, he'd cut his annual returns nearly in half. When you trade by pure rules, you remove that bias. The algo doesn't care about yesterday's pain or today's headlines. It only cares whether the conditions you defined are met. That's why Davey says the key to algo trading isn't just having rules, it's following them 100% of the time. I get it, there's a fear that rules make you blind to new information. But here's the reality: markets will always have noise. There will always be a reason not to take the next trade if you go looking for it. Your job isn't to filter that noise in real time. Your job is to build a system that already accounts for it. When you embrace pure rules, you start measuring success differently. You stop obsessing over whether the last trade won or lost, and you start focusing on whether you executed flawlessly. Because if the system is sound and you follow it, the results will take care of themselves over time. Think of it like flipping a loaded coin where heads pays you $1.50 and tails costs you $1. Your only job is to keep flipping. The moment you start choosing which flips to take, you lose the math advantage. Pure rules aren't about giving up control. They're about taking control in the one way that matters, over yourself. One of the greatest psychological advantages in algorithmic trading is knowing your strategy has already been tested across years, even decades, of market history. That's what backtesting gives you, a record you can point to when your emotions start whispering doubts. Kevin J. Davey emphasizes that most algorithms can be historically tested, and if they can't, you can often run them in simulation mode under live market conditions. Either way, you can gauge performance before putting real money on the line. That might sound obvious, but most traders skip it. I've met people who trade a setup because someone on social media swears by it, or because they saw it in a book, or because it makes sense. No testing, no data, just a story and a leap of faith. I used to think the same way. In my early days, I came across a strategy that bought stocks hitting a 52-week high. The logic seemed solid, strong stocks get stronger. I figured, why waste time testing? I'll just run it live. Within 2 weeks, I was underwater. I finally went back and tested it on 10 years of data. The result? Break even at best, with massive drawdowns. It wasn't the market that failed me, it was my lack of preparation. Now contrast that with how I trade today. Before any algorithm sees $1 of my capital, I run it through historical testing across multiple market conditions, bull runs, crashes, sideways years. I want to see how it handles volatility spikes, slow grinds, and news shocks. I'm not looking for perfection, I'm looking for resilience. Backtesting isn't just about finding winning strategies, it's about building belief in those strategies. When you've seen a system survive the dot-com bust, the 2008 financial crisis, and the 2020 pandemic crash in your historical data, it's much easier to trust it through the next rough patch. There's research to back this up. A 2019 behavioral finance study tracked 2 groups of traders, one using fully backtested systems, the other using untested discretionary setups. The backtested group stuck to their plans 32% more often during drawdowns and reported significantly lower stress levels. In other words, testing doesn't just improve performance, it helps you hold the line when it matters most. I once mentored a trader who was hesitant to trade her new strategy on the S&P 500. She'd built it to capture short-term reversals, but after a few losing trades, she wanted to shut it off. I pulled up her backtest, 20 years of trades, including multiple bear markets. Drawdowns like the one she was in had happened 6 times before, and each time, the system recovered. Seeing that history gave her the confidence to keep going, by the end of the month, she was back in profit. Without that data, she would have quit and missed the recovery entirely. The danger, of course, is thinking that a great backtest guarantees future success. It doesn't. The market will always throw you something new. But without testing, you're flying blind. And in trading, flying blind almost always ends in a crash. For me, backtesting is like training for a marathon by running in every possible weather condition: rain, heat, wind, even snow. You can't predict race day, but you can make sure you've already faced something like it. That way, when the storm comes, and it will, you won't be wondering if your shoes will hold. You'll already know. There's a myth in trading that somewhere out there is a single holy grail strategy that works in every market, all the time. If you find it, you're set for life. The truth? It doesn't exist. And chasing it will keep you stuck in an endless cycle of strategy hopping. Kevin J. Davey is blunt about this. No single algorithm works forever. Markets change. What works beautifully in a trending bull run can bleed money in a choppy sideways market. The pros know this, which is why they diversify both what they trade and how they trade it. When I first started building systems, I put almost all my faith in one trend, following strategy on the Nasdaq index. For months it crushed it. I was up big. Then came a summer of low volatility chop. Every trade felt like death by 1,000 cuts. Small loss after small loss until my confidence was gone. The problem wasn't the system, it was my lack of diversification. I had tied my emotional state to a single strategy's performance. When it hit a bad patch, I had nothing else to balance it out. Now, my approach looks completely different. I run multiple algorithms across multiple markets, equities, futures, currencies, even metals. And within those, I mix strategy types, trend followers, mean reversion systems, and even a few breakout plays. That way, when one group of systems struggles, another often picks up the slack. It's not just about smoothing the equity curve, it's about protecting your mindset. Drawdowns will happen. But if your portfolio is built so different strategies peak and trough at different times, you're far less likely to panic and shut everything down. I'll never forget the oil crash of 2014. My crude oil trend following system was getting hammered, one losing trade after another. If that had been my only system, I might have stopped trading altogether. But at the same time, my precious metals mean reversion Algo was having one of its best months ever. The net result? My overall portfolio barely took a dent. There's solid evidence for this approach. A 2015 study on multi-strategy portfolios found that traders using at least 3 uncorrelated systems saw average drawdowns reduced by 30 to 40% compared to single strategy traders without giving up long-term returns. That reduction in drawdown isn't just about numbers, it's about keeping your head clear enough to keep following the plan. Diversification also forces humility. You stop thinking any one system is the answer. Instead, you start seeing them as tools, each with strengths and weaknesses. You use them where they fit, and you accept that they won't all win at the same time. I often tell traders to think of their portfolio like a band. You don't want every instrument playing the same notes in the same rhythm. You want variety, different tempos, different tones. When one instrument drops out for a bar, the others carry the melody. The key, of course, is to make sure your strategies are truly uncorrelated. Running 3 different moving average crossover systems on 3 stock indexes is not real diversification. They'll likely all fail at the same time. The more unique your markets and approaches, the better your stress buffer works. So don't look for the one perfect algo. Build a team of good ones. Let them balance each other. Your future self and your equity curve will thank you. Patience isn't just a nice to have in trading, it's the hinge your whole strategy swings on. And in algorithmic trading, patience takes on a different form than most people expect. Kevin J. Davey compares it to running a marathon instead of a sprint. In discretionary trading, patience is often about waiting for the right setup to appear. In algo trading, the setups are automatic. The patience is in letting the system work without constantly interfering. I learned this the hard way. In my early algo days, I'd fire up a new system and, within a week, start judging it. If it lost money the first few days, I'd be on edge, wondering if I should shut it down. If it won big right away, I'd be tempted to over-leverage and strike while the iron's hot. Both reactions came from the same problem, impatience. I wanted immediate validation that my system worked. The reality is, even the best tested algorithms go through losing streaks. I've run strategies that had a 5-month drawdown before bouncing back to new highs. If you abandon ship too soon, you'll miss that recovery entirely. A trader I worked with recently had this exact struggle. She launched a breakout strategy on the S&P 500 and watched it lose on 7 of the first 10 trades. Her instinct was to stop trading it immediately. But when we looked at the historical testing, losing streaks of that size were perfectly normal, and the system had always recovered. She stuck with it, and 2 months later, she was net positive. There's science behind why this is so hard. Our brains are wired for loss aversion, the tendency to feel the pain of losses more intensely than the pleasure of gains. Studies show we feel losses about twice as strongly as equivalent gains. That means when your system hits a drawdown, it feels urgent to act, even when the data says hold steady. Patience in algo trading means trusting the math over the moment. It means resisting the urge to judge a strategy by a handful of trades and instead viewing it over hundreds. I sometimes tell traders, if you wouldn't stop a marathon at mile 2 just because you're winded, don't stop your system because of its first rough patch. One tool that's helped me is the delayed review rule. When I launch a new algorithm, I commit to a set period, say 50 trades, before making any performance judgment. No tweaks, no shutdowns, no panicking. Only after that milestone do I evaluate whether it's meeting expectations. This forces me to collect enough data for a meaningful decision and prevents me from reacting emotionally to noise. And here's the thing, often, by the time I reach that 50 trade mark, the system has already recovered from its slump without me doing a thing. Patience isn't passive. It's an active choice to let the system run long enough to reveal its edge. And it's one of the most underrated edges you can have, because most traders simply can't do it. In a market obsessed with speed, Patience is a competitive advantage. It's what keeps you in the game long enough to let your preparation pay off. If there's one temptation that haunts algorithmic traders more than any other, it's the urge to just tweak one more thing. Kevin J. Davey warns about this constantly, and for good reason. Endless tweaking can kill even the best strategies. Here's how it happens. You build an algo, you test it. It performs well, but not perfectly because nothing does. Then you notice that if you change one parameter, the backtest looks a little better. So you do it. And then another tweak. And another. Before you know it, you've optimized the system so tightly to past data that it has no room to breathe in the future. It's like building a key that fits one lock exactly. But the moment the lock changes, even slightly, it doesn't open. I once worked with a trader who had been perfecting the same system for over 5 years. He proudly showed me the equity curve, a flawless upward slope with almost no drawdowns. It looked like a dream. Then I asked to see his live results. They were mediocre at best. Why? Because the system was built for history, not reality. The market doesn't repeat itself exactly, and his hyper-optimized strategy couldn't adapt. This is called overfitting, and it's one of the most expensive psychological traps in trading. We think we're improving our system, but often we're just massaging it to match noise in the data. It feels productive, but it's actually destructive. The psychology behind it is fascinating. Tweaking gives us a sense of control. It's comforting to believe that if we just make the right adjustment, we can smooth out every bump. But markets aren't puzzles to be solved, they're environments to be navigated. A study in 2016 on system optimization found that traders who stopped tweaking after their initial validation period outperformed those who continued optimizing by an average of 12% annually. Less was truly more. The hard truth is, no amount of tweaking will remove all losses. Drawdowns aren't a sign your system is broken, they're part of its personality. If your testing has already accounted for them, then they're simply the price of admission for long-term profits. These days, I follow a strict process. I allow for one initial optimization phase after the system is built. Once it passes my out-of-sample testing, I freeze the parameters. The only time I revisit them is if market structure changes significantly, for example, a shift in volatility regimes that persists for months. This forces me to accept imperfection. It keeps me from falling into the endless what-if loop that leads to overfitting. The irony is, my live results improved dramatically once I stopped chasing perfection. I had more time to focus on building new strategies instead of endlessly adjusting old ones. And because I wasn't constantly altering parameters, my results became more consistent and predictable. Tweaking feels like progress, but in most cases, it's procrastination disguised as improvement. The best traders I know don't spend their time endlessly adjusting, they spend it executing. So the next time you're tempted to tweak, ask yourself, am I fixing a real, proven weakness, or am I just trying to erase discomfort? If it's the latter, step away from the keyboard. Your equity curve will thank you. Algorithmic trading isn't just theory, there's hard data showing how discipline and structure impact results. In 2019, researchers at the University of Essex studied over 300 active traders, comparing those who followed strict algorithmic systems with those who relied on discretionary judgment. The algotraders reported 35% fewer instances of emotional decision-making during trades, and their average annual return was 8% higher. But perhaps the most telling statistic was psychological. 92% of the algorithmic group said they fully trusted their process, compared to only 41% of discretionary traders. History gives us vivid examples too. During the 2020 COVID crash, many discretionary traders bailed out near the bottom. Meanwhile, systematic trend-following funds, which simply followed their rules, captured some of the fastest rallies in modern history once the market turned. Their discipline came not from predicting the recovery, but from executing their predefined plan without hesitation. I saw a smaller version of this with a trader I know who runs 3 different algos: a mean reversion strategy on gold, a breakout system on the S&P 500, and a volatility-based futures play. In late 2021, gold had one of its roughest quarters in years, and her mean reversion algo was bleeding. If that had been her only system, she might have shut it down. But her breakout S&P 500 algo was crushing it during the same period, offsetting most of the losses. By year's end, she was still net positive, not because every system worked, but because her portfolio was diversified. Academic research supports this effect. A 2015 paper from the Journal of Portfolio Management showed that blending just 3 uncorrelated trading strategies could reduce portfolio drawdowns by up to 40% without sacrificing returns. That kind of stability isn't just good for the account, it's good for the mind. It's much easier to stick with your plan when you're not riding massive emotional highs and lows. These examples, from global funds to individual traders, point to the same truth. Kevin J. Davey emphasizes, the real power of algo trading isn't the code itself. It's the combination of rules, testing, and diversification that allows you to execute with calm no matter what the market throws at you. Even with a solid algorithm, traders fall into patterns that quietly destroy performance. Here are 3 of the most dangerous I've seen and lived through. 1. Overconfidence and illusion of control. After a streak of winning trades, it's tempting to believe you've figured out the market. You start thinking you can improve the algo by adding a discretionary filter. The moment you do, you're back to trading on gut feel and usually erasing the edge your rules gave you. 2. Impatience and overtrading. Patience is hard when markets are moving fast. Traders often get restless when their algorithm hasn't given a signal for days. So they improvise, taking trades outside the plan just to stay active. These off-plan trades almost always have worse performance, but in the moment, the itch to trade overrides discipline. 3. Hindsight and recency bias. After a losing trade, it's easy to tell yourself you should have known better. This hindsight bias makes you second-guess the system's next signal, especially if the last trade lost. Recency bias piles on, making the most recent outcome feel more predictive than it is. Both biases push you to break rules that worked over hundreds of trades just because of 1 or 2 painful ones. The trap is that all 3 mistakes feel rational in the moment. Overconfidence feels like growth. Impatience feels like seizing opportunity. Hindsight bias feels like learning from mistakes. But in algorithmic trading, the truth is simple. If your system is sound, the smartest move is to follow it exactly. Before scaling an algorithm to full position size, run it live with small capital for a set period, I use 3 strikes. A strike is a loss or performance dip that matches the worst-case scenario from your backtest. If you hit 3 of those in a row, review the system before committing more capital. If not, scale up gradually. This builds confidence without risking a full account during the system's proving stage. Resist the urge to tweak your algo based on daily results. Instead, set a fixed time. I use Friday afternoon to review the week's trades. Ask 3 questions. Did I follow the rules exactly? Were the losses within expected ranges? Did market conditions match the system's strengths or weaknesses? This keeps you focused on execution, not on reacting emotionally to every single trade outcome. Both tools force you to slow down, act deliberately, and keep your rules intact. They create a buffer between the emotion of the moment and the decisions that actually shape your results. Take a second and be brutally honest with yourself. When's the last time you overrode your own trading rules? Was it because you had hard evidence the rules stopped working, or because you were uncomfortable with what the signal was telling you to do? How often do you judge your strategy after just a handful of trades instead of letting the long-term edge play out? If your algo hasn't given a signal in days, do you patiently wait, or do you start looking for something else to trade just to feel active? And maybe the hardest question of all, do you truly trust your system enough to follow it 100% of the time? Not 95%, not most of the time, every time. The answers to these questions aren't about proving you're right or wrong. They're about showing you where your biggest risks really come from. Because for most traders, the biggest risk isn't the market, it's themselves. If you take one thing from this talk, let it be this. The real edge in algorithmic trading isn't in the code. It's in your ability to run that code exactly as designed, through wins, losses, and everything in between. Your challenge. Write in the comments the most important thing you've learned here today. Then share this video with a trader you know who might be struggling to trust their own system. And if you found value in this, like, share, and subscribe so you don't miss the next deep dive into trading psychology. Master your mind, master the market, trade with confidence, and live with calm.